Joining us right now is Ed Yardeni. He is the president of Yardeni Research. And Ed, you're telling people that you still think markets will, the S&P will be closer to 7,700 by the end of the year. That's your target. That's up about 10% from here. But you do think it's going to be a rocky path. Why don't we talk about that?
Well, it's a rocky path today already with what we're seeing the administration do with regards to Jay Powell. Clearly, the market doesn't like it. Gold is at an all-time record high. So I did think we were going to have some turbulence related to the Fed. But I thought it was going to be when Trump actually picked his new Fed chair. I didn't expect that he'd actually go through with trying to investigate Powell. The other issue for me is the Supreme Court, maybe even on Wednesday, could rule that Trump's tariffs are unconstitutional. And the question is, then what? And that could create some uncertainty. There's certainly going to be lots of companies that are going to be demanding that they get refunded on the tariffs that they paid. And then, of course, there's my friends, the bond vigilantes. The bond yield last I looked was up to 4.2%. So the bond market could start to really show some discontent here. I thought it was going to be because the economy was going to be too strong on excessive monetary and fiscal stimulus, and that would push bond yields up, and that would create some uncertainty for the stock market. But it looks like this issue with the Fed could already cause the bond vigilantes to act up.
That's a pretty long laundry list of reasons that the market shouldn't go up. You didn't even touch on the geopolitical issues that are out there. What makes you think? What makes you think that the markets will rise in spite of all of that?
Well, earnings. This has been very much an earnings-led market. And the reason earnings have been so strong and resilient is because the economy has been so strong and resilient. I mean, Becky, think of all the things, all the shocks that have hit this economy since the beginning of this decade, which I still call the roaring 2020s. For example, we had the pandemic, and then the pandemic led to lockdowns. The lockdowns were lifted. That led to a surge in demand for goods. That led to supply disruptions. That led to inflation. The Fed tightened, and then we had tariffs last year. And here we are at an all-time record high for real GDP and S&P 500 earnings. And by the way, the fourth quarter earnings season, reporting season, which we're in now, is likely to be another very strong one with a record level of profits.
All right, let's go back to some of the macro issues that are out there. You raised these issues of the Fed. Obviously, that's front and center for the markets this morning. You're anticipating that there will be no Fed cuts in the first half of the year. If there is another Fed cut, you say you're worried about a melt up. You want to explain that?
Well, yeah, I don't think there's really that much cause for the Fed to move and lower rates. As a matter of fact, I've been on the wrong side of this issue for a while, but the Fed just won't listen to me. My position back in 2024, when they lowered rates by 100 basis points, is that the bond vigilantes wouldn't agree with that. And sure enough, bond yields went up 100 basis points. And here we've barely had a drop in the bond yield, with the Fed cutting last year by 75 basis points. So I don't really think that the bond market is signaling that there's a need for these lower interest rates. And so if the Fed just continues to lower rates, to a large extent because of pressure from the administration, that could create a melt-up, because a lot of that easing of a lot of that liquidity isn't really going to go into the economy, which from a real GDP perspective is booming, but it's going to go into the stock market.
We're showing the big banks right now. All of them are lower, some of them substantially, after the president said that he's thinking of trying to get them to put a 10% cap on what they can put on credit card interest rates. What do you think of that? Because you've also said that you think banks will lead the way with these earnings.
Yeah, well, I did when I wrote my piece for today. I didn't anticipate that the president was going to come after Powell this way, and so I think this clearly is a reaction to not just Powell, but also this idea of capping interest rates at 10% on credit cards. I think that's going to require some legislation, which has to be passed by Congress, and I don't think that's going to happen. Also, the banks have tremendously powerful lobbyists. I think they're going to keep that from happening as well. Look, this administration puts out a lot of trial balloons and see which ones make it up into the stratosphere, and I don't think this one's is going to fly.